Good afternoon, everyone. My name is George Kyriakopoulos.
I'm Seisimo, Olali.
I'm Jada, Antoine.
We are the Chapter 9 group, and we will be presenting on insurance today. So the importance of insurance. So we're going to talk a lot about insurance policies, why insurance is important, and when it's applicable to get insurance, and when it might not be applicable to get insurance. So insurance is a very important issue. Many people avoid thinking about end of life. Many people avoid thinking about the kind of health problems that they could encounter along the way. And a lot of people don't purchase life insurance policies, and a lot of other people don't purchase health insurance policies or can't afford to purchase health insurance policies. So prior to insuring, it is very, very important to remember the purpose of why you're purchasing insurance prior to deciding on a plan and coverage options that are right for you. An insurance policy essentially lays out your coverage, the costs, or in this case, premiums, which is what the industry term is, and the beneficiaries, basically who gets your the payout of your insurance policy upon execution of the contract or when you die, etc. And the purpose of insurance basically is to shield you from overwhelming bills. So say in healthcare, if you have high medical costs, insurance is there to cover you for it. Or life insurance, if you have high funeral expenses or something related to that, that's what it's there for. But why is healthcare so expensive? So medical care uses very expensive equipment. Some equipment can cost hundreds of thousands, if not millions of dollars, and obviously the price to use it for testing purposes when you go into a clinic is very, very expensive. Medical care and procedures can be very complicated, so surgeries and procedures can sometimes take hours and can leave somebody, if it's not an outpatient surgery, in a hospital bed for a couple of days, if not longer. The healthcare system is also very expensive because there's no real incentive at the moment to make things more economical. So although firms are, large commercial firms, it's kind of really hard to actually shop around for a surgery or a procedure based on price, just because that's not usually how people seek out medical care. Rather, they go to a specialist or they go based on where their doctor recommends. So there's really no need at the moment to make things more economical. Especially if you do have insurance will usually take the brunt of whatever the medical expenses are. So it doesn't make it very much incentivized for these firms to lower their prices. Another very, very big reason why healthcare is so expensive has to do with the rate of medical malpractice lawsuits. It's actually one of the highest growing forms of litigation in the United States at the moment. And it basically happens when a doctor or a clinic or a nurse performs a malpractice, does something wrong that goes against kind of the standards of the industry, or hurts the person or et cetera in a procedure. And basically, it's when the plaintiff, who would be the person that's receiving the medical attention, sues the firm or the clinic or the hospital. And these cases can often go for millions of dollars. So these firms have to purchase really expensive medical malpractice insurance to ensure that if this does happen, which it happens pretty frequently, that they're covered for it. So they kind of pass those expensive costs on to you. So all of these high costs translate to higher out-of-pocket payments when it comes to paying for your healthcare, limited benefits when it comes to your policy, and also restrictive coverage. So what if you don't have health insurance? So this was a very, very big problem. It still is, but it was improved slightly by the Patient Protection and Affordable Care Act, which a lot of us are very familiar with. But if you're not, what it does is it's an act that was passed by Congress that provides coverage to those who are uninsured. The problem with the Affordable Care Act is it's currently being contested and it could be repealed in the future. And currently there's no plan set in place to replace it. So basically what the Affordable Care Act does is it mandates everybody to get insurance, and everybody having insurance kind of collectively will lower the premium in theory of each person if more people have insurance. So that's being very contested, and there's a lot of different intricacies with the Affordable Care Act that we can't really get into, but just know that approximately 20 million Americans are estimated to have been enrolled in this program as of 2020. And you can visit healthcare.gov, which is the online policy marketplace for health insurance. And essentially, you can go in there and shop for a plan. They have enrollment periods, which I believe the enrollment period has just ended. But you can still shop for plans and price plans and all that through healthcare.gov, which is an actual government website. So, how many Americans actually have life insurance? So, switching gears into life insurance from health insurance. So, less than 60% of Americans actually have life insurance, which is pretty scary. The actual number is about 54%. So with medical costs rising, so too does your risk of financial hardship due to healthcare related expenses, obviously, right? So a couple things to ask yourself: do you need life insurance? So we'll go through Table 9.1 in just a second, which I think is a really useful tool to be able to figure out whether or not you actually need um, a life insurance policy or not, or whether you can afford to not have one. Essentially, what insurance does, just from a general insurance perspective, is it pools risk together and is funded by policyholders paying premiums. So it's basically one big fund that people pay into on a monthly basis, and via the premiums. And when somebody needs a payout, they get paid out through the fund that everybody's been paying into. So it pools that risk together and it lowers the risk much more of the fund running out of funds. So how are insurance policies actually calculated? So actuaries use something called actuarial science, where they actually use tables and statistics to figure out how long someone's going to live based on their medical records, if they have any underlying conditions, XYZ, how long they're going to live, and how much they should charge for a policy via premiums. Along with that, plan beneficiaries are those that will receive the proceeds of your policy, whether that be your children, your estate, or whoever you pretty much name. It could be your spouse. It depends on the contract provisions, which we'll talk about. So should you buy life insurance? You may not want to buy life insurance if you're single and you don't have any dependents. So you're not really insuring for anything if you pass and there's nobody that kind of depends on you. If you're married with a double income couple with no children, so if your spouse has a very good income, wouldn't really be affected by your passing as far as income goes, then insurance might not be needed. Consider life insurance if that surviving spouse will have a lower quality of life or be really affected by your lack of income once you pass. If you're married but you're not employed, that could be a big problem. If you have young children, you have to really consider, would your spouse have financial problems taking care of the children, taking care of your home if you were to pass. If you're retired, you should really consider it, because you got to think about if your spouse is going to actually be able to live off of your Social Security, pension, retirement plans that you have, and what that's kind of going to look like. So that's really going to depend on you. It's recommended that you need life insurance if you have children. Just in general, the cost of raising children and the cost of education is getting higher and higher, as we all know. Until they're financially sufficient is very, very high expense, which we talked about earlier in the class. If you're married, a single income couple with no children, so if you are married and you are the primary income earner, you should definitely have insurance so that your spouse can maintain their lifestyle until they can get a job and become self-sufficient themselves. If you own your own business, a life insurance policy can actually help your family to pay off any outstanding debt that the business had. And something that's really important to know, we've been talking about the estate tax-free transfer threshold of the 11.554, I believe, million. As of the current tax policies, back in 2014, this was 5.34. So obviously it's expanded a lot, but basically life insurance is really effective for passing on your estate without incurring taxes. So basically this lump sum payment, if you choose it to be a lump sum, is tax free, and your beneficiaries aren't going to have to pay taxes on that. Also, something to note: these companies don't pay taxes themselves, because basically you pay into the plan and you've already paid income tax, presumably. So you pay into the plan with already taxed dollars. It goes into the fund, and just like mutual funds don't get taxed, these insurance companies don't get taxed in a similar way. They get other taxes, obviously, but not that kind of tax. So now let's design a life insurance program together. Prior to doing that, it's really important to determine when looking at life insurance policies, what exactly are you going to need, right? So there's two major industry approaches to determining this. There's the needs approach and the earnings multiple approach, which is a more quantitative way of trying to figure this out. So earnings multiple approach to determining life insurance policy needs. So basically, the idea of the earnings multiple approach is that you want to replace a stream of income that the insured person would provide to the household. So the earnings multiple approach often represents a lump sum that would be needed to replace that yearly income. And in order to calculate this, we'll look at the table now, but we're going to multiply your gross income by the multiple that is on the table. And that multiple is going to depend on the number of years that you're going to want coverage for and the rate of return on the lost income, which could be more conservative or more aggressive depending on where you think you're going to need. So many people say they need 10 to 15 times their income to be able to support a life insurance policy that makes sense. Some people say 18. So it really depends on your needs. So let's go ahead and look at the earnings multiple approach for life insurance table. So let's say, for example, you are the primary wage earner and you want to leave money for your children, right? A very realistic example. So basically, you're going to look at a life insurance policy. Say you want 15 years of lost income at a conservative 3% return after tax and inflation on your payout. So you would follow the table and you'll see 15 years and 3%, and you'll see that the factor is 11.94. That means you would need to multiply your current annual earnings by a factor of 11.94 to get the lump sum amount that you would need to replace 15 years worth of your lost income as a head of household wage earner. The needs-based approach is a little less quantitative, and it really focuses on the family's needs after the death of a primary income earner. Funeral expenses, which are very, very high. Debt elimination plans, which are actually very interesting. Basically, it helps reduce the exposure to bankruptcy risk and maintain the credit score of the family after the death of a primary income earner. Like this has to do with, basically it's a debt restructuring plan. So you kind of do a payment plan and you're able to work with these companies to be able to make sure that you stay out of bankruptcy trouble, stay out of credit score trouble, and be able to pay back within a reasonable amount of time. So it's really, really useful actually. Transitional funds, money between when your spouse passes away and when you're able to get a job, say if you weren't able to work. Dependency expenses, so do you have any dependents? Obviously there's costs there. Spousal life income, so sometimes there's options like where you'd be able to replace a stream of income, say through an annuity plan, depending on the life insurance payout that you want to get. And that would kind of replace the spouse's income for the rest of the surviving spouse's life. Education expenses for your children. Obviously, we've talked about that. Very expensive, definitely something to consider when looking at your needs. And your retirement income, so your Social Security, retirement plan, pension plan. All these factors are really important to determining what kind of life insurance policy you're going to need. So let's tune our policy to suit us. So I looked at a lot of kind of insurance tech online quoting websites, and I've found a really good reputation for ladderlife.com. So basically, it's through Policy Genius. It basically helps you, you answer a questionnaire about your health, about your family's history, if you work out, if you're a smoker, non-smoker, how old you are, your location, where you live, what you do. It's a pretty long questionnaire. But then you look at the coverage amount you want, and then you can choose policy length. So here you can see I want a $1 million policy that lasts for 20 years. So I'm looking at around $30 a month, but it really doesn't end there. That's kind of where it starts at. The website also allows you to choose from a lot of different providers, which is very, very important. Obviously, you want to get a plan from a very reputable insurance provider because obviously the risk of default on your insurance plan is a lot lower, even though insurance companies are supposed to carry insurance on your insurance, which is very interesting. Obviously there's still a risk of default if you go with a lesser known company that may not be as big as, say, a Fidelity or something like that. So the website allows you to go through and see the credit ratings of the different companies that provide these plans, which is very important. So kind of in tuning up our policy to suit our needs, contract terms and clauses, which definitely recommend that before you sign any of these kind of contracts, definitely take it to a lawyer who specializes in these kind of things, because these terms can get very, very complicated. And obviously we're very impressionable. We want to get our plan as soon as possible, but it's really important to make sure that we don't get cheated out of our benefits if we're paying into this contract, right? So definitely worth a trip to a lawyer to check that out and make sure it's all good. Beneficiary and coverage grace provisions. So who gets the money after after the policy gets executed, the person passes away, who gets the money? That's the beneficiary or the estate. Coverage grace period provisions. So if the coverage lapses, is there a certain period of time that the coverage is still good? Low non-forfeiture and policy reinstatement clause. Let's say you stop paying into your monthly premiums. Non-forfeiture will say, oh, after this many months of not paying, you're still entitled. Basically something along those lines. Taking out loans on insurance policies, which is interesting because you've been paying into this premium. Policy reinstatement clause. So if your policy lapses, is there a way to get back into your policy after you've paid all this money? Change of policy and payment premium clause. Suicide provision, goes without saying if you still get a payout after that. Riders, which basically has to do with this change of policy. So basically riders allow you to change the standard contract terms to kind of better suit and tailor your needs. You do have to pay for them, but it's something that you just kind of it's basically alterations you can make to a contract on a variety of different things actually, to be able to better suit the contract to your needs. Waiver of premium for disability. So if you become disabled, having to pay your premiums, what's the situation with that? Accidental death benefits, multiple indemnities, living benefits rider. So if you live past your the date of your policy, cost of living adjustment rider. So is your payout going to be adjusted for inflation, cost of living expenses, XYZ, as time goes on? Which is also known as COLA. So it's actually a very important thing to consider if your policy is even going to be relevant because of the cost of living changes that occur over time. And then finally, we get into settlement and payment. So there's a lot of different options for this. There's an interest-only settlement, a lump sum settlement, which, like we mentioned before, it's the one-time humongous payment. Installment payments. So this can act almost like an annuity, or you can get paid on a monthly basis. It really depends. Talking about annuities, like a life annuity settlement. So basically, you'll just get paid a stream of income for the rest of your life. There's straight life annuity, certain period annuity. So you get paid for, say, 10 years. Refund annuity, joint life and survivorship annuity. So surviving spouse, joint life, you live past your policy term. What happens with that annuity? So these are just a lot of different factors. So now I'm gonna pass it on to types of coverage.
All right, so so you have a couple different options for types of coverage. So in terms of your life insurance available, you have the term life insurance, the cash value insurance, and then you have 3 different options under those. So you have the whole life insurance, the universal life insurance, and then also the variable life insurance. So for the term insurance, you have a coverage period for a specified period of time. So 1 to 30 years, typically. This is generally the least expensive life insurance policy. We have a low initial premium, but we also tend to get a high renewal premium. And then we also have a fixed death benefit and also no cash value. So for the major types of life insurance, so we have kind of a visual representation on the left-hand side for term insurance, and it kind of gives you the term premiums. So on the x-axis, we have our ages from 35 to 85, and then on the y-axis, we have the annual premiums. So you can see there's a significant uptick in the price of the term premium after age 55. So if you bought a 10-year term premium, 10-year policy, from 45 to age 55, there would be an exponential increase in your annual premium. So that's super important to kind of take into account kind of the significant uptick we see in the premium. And then the table just kind of gives us the coverage periods and the death benefits, but we'll get into more detail on those. All right, so types and features of term insurance. So we have the convertible term. And so this is kind of an attractive option because it allows the policyholder to convert the policy to a permanent insurance at a given period of time. Then we also have the annual renewable insurance policy. And this is kind of attractive because you're able to renew your term insurance without going through the eligibility process. So then we also have mortgage and decreasing term insurance. And so this offers a level non-changing premium. And the death benefit actually decreases after every year. The main use of kind of like the decreasing term insurance is in the case of basically to insure a mortgage. So basically the policy decreases as the loan balance also decreases. So at the end of the term, the death benefit would be 0. Then we also have the group term. And so the group term works in a similar manner, but so it's generally a part of a master contract offered by the employer. And so this is generally a much cheaper option than basically an individual life insurance plan. So then we also have the whole life insurance. So the whole life insurance provides coverage for the whole life of the insured. It also, really important feature is the cash value savings account accumulation. So the way it works is you pay a monthly or annual premium, and a percentage of the premium that you pay goes towards the company, their profit, their operational costs. But then a percent of the premium also goes towards the death benefit and the cash value savings account. And it works in an interesting way. So you get a percentage basically goes to the cash value account, and you also have the ability to make withdrawals, but definitely be cautious not to continuously withdraw and drain your account. So the cash, the savings account, it basically grows on a tax-deferred basis. So basically, it's equity for the policyholder. And then we also have a non-forfeiture right for the cash value. So it basically means that if you opt out of your policy, you surrender, you stop paying your monthly or annual premiums, then you still are entitled to the cash value that you've accumulated, previously. So then we have the universal life insurance. It's also known as the adjustable life insurance, and it offers increased flexibility. It allows you to basically control the frequency of your premium payments. So based on your kind of your financial situation, your liquidity, if you want to pay the premiums on a more frequent basis or as a lump sum, you have that option, and this could be based on your desired death benefit, whatever it may be. Also, for the universal life insurance, you do have to pass certain medical examinations to qualify based on your medical history. Any possible pre-existing conditions you may have is going to go into how they basically judge how much risk they're taking, and basically how high or low your premiums are going to be. For the universal life insurance, you still have the ability to make cash withdrawals. For the universal life insurance, there is some risk associated with buying this policy. There is, change, policy interest rates definitely fluctuate. So your cash value savings account may not be what you projected to be. So there is some risk. So you're still paying, you could still potentially be paying a high premium, but have a low performance based on the policy interest rates. All right, so determining your cash value accumulation. So there's a couple different factors which kind of play a role in the cash value account and how it grows. Like I said before, a percentage is allocated to the death benefit and the profit for the company, and then another percentage to the cash value account. So the basic idea is, as years go on, you continue to pay your premiums. Your cash value is going to increase. Another interesting component of the cash value is that actually the growth of the cash value tends to slow as you grow older. So as you get older, there's more risk associated with death. So a greater percentage of the premium payment is actually allocated towards the cost of the policy. So this just kind of gives you a basic breakdown of your insurance costs, your monthly or annual premium that you may pay, and how it's calculated by underwriters. So the underwriter is basically going to look at your profile and kind of figure out how much risk are we really willing to take with this individual. And they're going to look at a couple of different factors. They're going to look at your age. They're going to look at your gender. They're going to see if you have a term policy. What is the term length? Is it 10 years? Is it 20 years? Is it 30 years? They are also going to look at your medical history. What pre-existing conditions you have. Are you exercising on a regular basis? They're going to look at a lot of these different factors to come up with that number. Another common factor they often use is just possibly occupation. So a firefighter is going to be have a higher premium than, let's say, a stamp collector, because there's obviously more risk generally associated with that particular occupation. So variable life insurance provides policyholders with permanent protection. It's one of its kind of attractive features is the flexible premium. So you have more control over the frequency of your payments. And then the death benefit and also the cash value account are interesting enough, reflective of the performance of the policy's sub-accounts. For the variable life insurance, policyholders also have kind of more control over investment risk and also the policy investment strategy. So there's definitely a couple considerations when you are, going about buying a life insurance policy and choosing a policy. You're definitely going to want to look for a professional designation. One way you can do it is just going to the NAIFA, which is the National Association of Insurance and Financial Advisors, to make sure you're getting that professional designation. Your agent should have a license by insurance in the insurance department in your respective state. Your agent should have a personalized document with your full financial profile, your goals, whatever it may be. So if they don't have that, it's definitely a red flag. You definitely want to get a quote from a couple different insurance agents just to make sure they're all within the ballpark. No one's giving you an incredibly high number. So how much will your policy cost? So there's a couple key methods that we look at in terms of calculating the cost of these different policies. So we have the TNC, the traditional net cost method, and then the interest adjusted net cost method. So the interest adjusted net cost method, it just kind of takes into account the time value of money. And we're actually going to do a quick example. I'm going to just show you a chart on the next slide to kind of get a better idea of how you would go about calculating it. All right, so on this slide, we're giving a couple key pieces of information. We're giving the annual premium, the number of years of the policy, the cash value at the end of 20 years, as well as the projected dividend for 20 years. So then the calculations would just be below. So the total premium for 20 years would simply just be the annual premium times the number of years, which would give us $8,000. And then 400 times 20. And then we would subtract the dividend for 20 years, which is also given above, projected dividend of $600. Then we just take the total premium and subtract the dividend, giving us $7,400. Then we would from there subtract the cash value at the end of 20 years, giving us the insurance cost for 20 years of $4,900. So once we get to this point, we would simply divide, we would take the $4,900 and divide it by our 20 years, giving us $245, so a net cost of $245. All right, so in terms of kind of designing your healthcare insurance program, there's several different considerations. So you definitely want to look into, who's covered, the terms of payment, possible exclusions in your insurance. So cosmetic surgeries, behavioral and learning problems, those would generally not be included in the kind of very basic healthcare package. And then you also want to take a look into out-of-pocket expenses, such as the deductible. So that's your upfront costs that you would incur before your coverage actually begins. So for healthcare, the majority of employees are covered by the employer sponsored healthcare coverage. They get several different employee health benefits, such as the HRA, which is tax-free, which is the health reimbursement arrangement. So if you don't have the employer-sponsored healthcare coverage, we do have the healthcare insured exchange, which is a marketplace for the enrollment and medical insurance. So this is basically a platform that is very good for individuals, families, small businesses, and it's also quite accessible. You can access it online via the website, in person, or even through call centers. So also for the 2010 healthcare reform, the Affordable Care Act, which we talked a little bit about before, just kind of going over that again. Improve the overall quality of healthcare. The affordable made it much more cost effective for all demographics and socioeconomic backgrounds, and it also just improved overall public accessibility. So yeah, just going into more detail in regards to the basic healthcare coverage, also known as MEC, the minimum essential coverage or qualifying health coverage. It's a general requirement for most Americans. The coverage extends to hospital, surgical, and physician expenses insurance. So all your basic needs are included. So for the kind of basic healthcare options, you have a couple different options. You have the traditional fee-for-service, or the indemnity plans. So for the traditional fee-for-service, you're reimbursed for different medical expenditures, and then for the managed healthcare or prepaid care plans, the HMO, most of your expenses are going to be covered, but you do have a limited choice of doctors available and clinics. It's received, all healthcare is received at one basic location, and there is a visit fee or a co-payment. So in terms of the government healthcare sponsored plans, the state plan offers care for work-related incidents, accidents, and illness. So this would be like workers' compensation. So then we also have federal plans, which include Medicare, Medicaid. Medicare covers several different things. Hospital insurance, supplemental medical insurance, Medicare prescription drug coverage, Medigap plans, and then the Medicaid is included in the federal and state program, and you actually can qualify for both based on some criteria. So putting for healthcare costs, there's a couple different things you can do in accounts you can open to kind of reduce some of the costs you may incur. So we do have the flexible spending accounts, and then also the health savings accounts, the HSAs, which are really nice because they lower your monthly insurance premium. And also the money that's put into these accounts is actually not taxed. And also there's also a tax-free interest rate on the HSA balance. And then we also have the COBRA. The COBRA is also a nice plan because it offers retirees, former employees, and also the dependents of the children to access healthcare coverage and group mates, which is less expensive than individual insurance plan. And then you also have the option of choosing no coverage or opting out. So you have several different options to kind of take into account for. So it's definitely important to do your research on all of these. Now we're going to kind of shift into disability insurance.
All right, thank you for that. So, disability insurance. Disability insurance is health insurance that provides payments to the insured in the event that income is interrupted by illness, sickness, or an accident. So, who's it for? It's for anyone who relies on income from a job and needs disability insurance. A fact is that a 30-year-old has a 47% chance of incurring a disability that would cause 90 or more missed work days. Another fact is that it's very expensive. As a rule of thumb, disability insurance can cost from less than 1% to more than 4% of the income you're looking to protect. And as an average, it's somewhere near 2% of your income. So sources of disability insurance. The main source of disability insurance protection is provided from your employer. Many employers, especially larger ones, provide their employees with group disability insurance coverage. And there are two forms: short-term disability insurance, which replaces a significant percentage of your income for about 3 months in most cases, and long-term disability, which typically pays 40 to 60% of your base salary pre-tax for longer periods. The next source of disability insurance is Social Security. So according to Social Security Administration, 60% of applicants for Social Security disability benefits were initially denied. So if you become disabled, you may be eligible for Social Security benefits, but you must meet the following requirements. So you must not be able to engage in substantial gainful activity because of a physical or mental impairment. Your impairment has to be determined medically by a doctor. It is expected that your impairment can either result in death or last for at least 12 months in a row. And your impairment must be the primary reason for your inability to engage in substantial gainful activity. And if your claim is approved, there is a 6-month waiting period before your benefits will begin. The next source of disability insurance is workers' compensation. So if your disability results from work-related illness or injury in a job, you'll be eligible to receive benefits from your employer's workers' compensation insurance. The next is an individual policy. So an affordable individual policy could provide you with a monthly benefit that is income tax-free when you pay with a premium. And when you buy a private disability income policy, you can expect to replace 50 to 70% of your income. And for most workers, even those with some employer paid coverage, an individual disability income policy is the best way to ensure an adequate income in the event of disability. So next up are some disability features. First is the definition of a disability. A disability is a physical or mental condition that limits a person's movements, senses, or activities. Next is the residual or partial payments. So this falls under residual benefit, and it is provided by disability insurance that provides the policyholder with part or of the total benefits outlined in the policy. The next is benefit duration. This is the total length of time the benefits will be paid. It applies to workers who are out on short-term or long-term disability, waiting or elimination period. Both short-term and long-term disability policies have a period that a person must be disabled before that individual is able to start receiving disability benefits. The waiver premium for disability is a provision in an insurance policy that states the insurance company will not require the insured to pay the premium if they are seriously injured. A non-cancelable, and this is very important, a non-cancelable insurance policy is a life or disability insurance policy that an insurance company can't cancel, increase the premiums on, or reduce the benefits of as long as the customer pays the premium. And a non-cancelable gives the policyholder peace of mind that the cost, the amount of coverage, and the term are known, and they won't have to requalify for the policy at some point in the future when their health might not be as good and insurance might be harder to get in the future. And lastly is the rehabilitation coverage. Your insurer may cover the cost of your rehabilitation to help you recover from your disability. So next is long-term care insurance. So long-term care insurance, odds are high that someone in your family may need a nursing home or some type of care sometime in the future or sooner or later. Someone turning 65 today has almost a 70% chance of needing some type of long-term care, and 20% of people will need it for longer than 5 years. So what does long-term care insurance cover? It covers nursing home expenses, home health care. It covers the costs associated with long-term care for those against the financial cost of Alzheimer's, strokes, or chronic diseases. But with long-term care insurance, there are some requirements. It requires that the insured cannot perform at least 2 of these activities of daily living. It requires that they can't bathe themselves, dress themselves, transfer into a bed or a chair or a wheelchair by themselves, toileting by themselves, continence, which is the ability to control their own bowel movements, or eating. So they can't do at least 2 of those things. Type of care under long-term care insurance is nursing home care, adult daycare, and hospice for the terminally ill. Additionally, long-term care coverage can cover short-term hospice care for individuals who are terminally ill. And the objective for hospice care is to help with pain management and provide emotional and physical support for all parties involved. Most policies allow beneficiaries to obtain care at a hospice facility, nursing home, or in the comfort of their own home. Next is the benefit period. So for long-term care insurance policies have either a defined benefit period or a lifetime benefit maximum, which is the total amount of time or total amount of dollars up to which benefits will be paid. Common benefit periods for long-term care policies are 2, 3, 4, or 5 years. There is even a choice of lifetime or unlimited coverage, although this option may be considerably more expensive than others. Other options between 5 years and a lifetime unlimited coverage are also available from many other companies. Most long-term care insurance policies have waiting periods for benefits before benefits begin to kick in. You'll have to cover all expenses during the waiting period, so choose a waiting period you think you can afford to cover. A longer waiting period can mean lower premiums, but you need to be careful if you need to be careful if you're getting home care. Look for a policy that bases the waiting period on calendar days. For some insurance companies, the waiting period is not based on calendar days, but on days of reimbursable service, which can be very complicated. Some policies may have different waiting periods for home health care and nursing care, and some companies waive the waiting period for home health care altogether. Inflation adjustment. So inflation adjustment protects the insured from inflation. An insurance policy it's an insurance policy feature in which the value of the benefits increases by a predetermined percentage at specific time periods to keep up with inflation. Inflation protection is designed to limit the negative effects of more expensive medical care in the future. Insurance inflation protection is designed to allow policyholders to make sure that the benefits they receive can keep up with general price levels. There are also options for inflation adjustment. The first is to purchase as much daily benefit as possible. It's a great option for older individuals, and this may be more because it may be more cost efficient than a specific inflation protection rider. The second way is the guaranteed purchase option. This type of rider is a policy is to increase the daily benefit every 2 or 3 years with no additional underwriting. However, at a policyholder's attained age, it will be more expensive. Also, if you've rejected this offer in the past, an insurance company may consider a policyholder ineligible for this rider. And then last and third method is simple inflation. This protection is usually included in the cost of the premium. The premiums for this policy will often be 40 to 60% higher than those without this rider, and this rider increases the daily benefit by 5% each year. And then the waiver of premium for long-term care insurance. The insurance company waives the premium payments each month you're receiving care. The most waiver of premium benefits apply to care you're receiving in a nursing facility, assisted living facility, or in your home. And insurance stays in force while you receive benefits. So an example of waiver of premium. Say your budget allows you to pay your $300 monthly long-term care insurance premium. Unfortunately, you wind up needing care that exceeds your policy's benefits by $300 per month. The waiver of premium benefit will allow you to stop paying your $300 monthly premium, leaving you with a balanced budget. Thank you. Any questions?